jump in. So a little bit about me. Some of you may know, some of you may not know. My name is Yannick Cudjoe-Virgil. Our company is called Merlin Acquisitions. We primarily focus in the Baltimore metro market. Got into real estate about 5 years ago, and realized that commercial real estate was the place to be. We primarily focused on multifamily assets, B&C, workforce housing, again, primarily in Baltimore City. Began as a trade by asset manager, moved to different private equity firms, and went out and did my own thing officially last April. And so on our website here, we have a ton of different resources available. One of the key resources is the due diligence checklist. Basically a total checklist, soup to nuts, about how to perform due diligence or what to look for rather in multifamily assets. We also have a syndication guide for passive investors, anyone that's looking to learn more about the syndication process, what to look for, who to invest with, etc. We have an investor group as well. If you're interested in doing any passive investing, definitely fill out a form. Would love to talk to you to see if our goals have any synergy. And here's our investor portal as well for investor access on deals. So let's go ahead and get started to talk about structuring investor returns, right? Investor returns obviously vary from investor to investor. I'm just going to switch this PowerPoint here really quick. All right. So investor returns, obviously they vary by property to property, project type to project type, right? It depends on, it's really no right or wrong answer on how you should structure your returns in the world of commercial real estate or just real estate in general. The structure has to be an alignment of interest on both sides, whether it's you as the active person that's doing all the work on behalf of your investors, and also the investors who are taking the risk to invest with you as well. And the biggest thing is just structuring it in a way that's profitable for both sides, right? You always want to make sure that your investors are compensated first by any means. However, you do want to make sure that you're compensated as well, because there is a ton of work that is required to turn these deals around. Specifically, on apartments, these deals, the life cycle is between 2 to 5 years, depending on how quickly, you sell or how quickly you could turn the project around. And so you want to make sure that, everyone's compensated fairly on both sides, right? So, one sec. Let's go ahead and take a look at different, investment return metrics, right? What are the ones that, your investors might be looking for within their investment opportunities? The biggest one, honestly, is none of them, right? It kind of depends on your investor. It depends on what your investor is looking for, whether it's a cash on cash return, whether it's an average annual return, an internal rate of return, equity multiple, yield on cost, or just a cap rate, right? The biggest thing is that, what language does your investor speak? Because some investors understand deeply what internal rate of return is. Some just understand what cash on cash return is. And I always like to say, a closed mind says no, right? If someone doesn't understand something, it's likely that they're not going to invest with you. So a lot of times when I have conversations with investors, I don't try to, sound super smart and show off and do all of that. I try to meet the investor where they are, because I want to make sure that I'm explaining it to them in a way that's easy to understand, that they can share with their spouses, their family members, that they can share with their colleagues and talk about what they're investing about. Because at the end of the day, you want to meet your investor where they are, right? And so a retail, investor, someone who, maybe works a W-2 job, wants to invest, might just be interested in cash on cash return, right? Because it's an easy metric to understand, average annual return as well. Whereas on the institutional space, the primary driver for investments is either the yield on cost or some sort of IRR metric, right? But the biggest thing, that I wanted to convey here is that just speak in the language that your investors speak. Because if you try to sound too smart, you may shoot yourself in the foot. They may say, well, you're talking too smart. This looks like something. And I've had that before, right? I've had an investor that was ready, willing, and able to invest, started going down a rabbit hole talking about internal rate of return. And she's like, well, this kind of sounds a little bit too high level. I don't think I want to invest, right? Little things like that. You want to make sure that you're speaking to your investor. All right. So retail versus institutional return structures can be totally different. The capital on the retail side is a little bit softer compared to high level institutional capital that looks at metrics more on a detailed level. Is a little bit more financially astute, right? Because obviously they have millions of dollars, and probably for some reason, but they also have access to data, and so that they're just analytic by nature, right? So the different return structures, right? So one return structure on the retail side is just a typical pro rata share split, right? That's maybe an 80-20 split. On one side, the limited partners, they own 80%. The general partners or the sponsors own 20%. You split it straight down. It's easy, it's simple, right? And this also is commonly seen in a joint venture typical structure. Easy to do, easy to understand. Another one is, a pro rata share split with a preferred return that's either accrued or not accrued, right? So an example can be a 70-30 split, 70% to the limited partners or your investors, 30% to the sponsors or the folks who are leading the deal. The first 6%, 6 to 8% of cash flow would go to your LP investors, and then the remaining would be split 70-30, right? And we like to do preferred returns because we like to make sure that our investors are compensated first. And the reason is because we believe that our investors are truly the lifeblood of our business, right? In the world of real estate, if you can't raise capital, you can't scale, right? And our investors are trusting us with investing their capital and making sure that we're protecting their capital as well. And so we want to give them an additional benefit to invest with us in a preferred return structure, right? So the first X percent goes straight to the investors. Depending on the deal, some people do accrued and not accrued. So, a deal might be structured in a way that it accrues year over year. So if you have a 6% return and you only distribute 5, that 1% goes to the next year. So you try to get that 7% hurdle. If you don't hit that 7%, then it goes, kind of down the line, right? Sometimes you're going to see that. Sometimes you may not see that. It kind of depends on the operator and the risk on the deal as well, right? As an operator, you definitely don't want to shoot yourself in the foot if you feel like the deal, has some sort of heavy value add to it, and you may not be able to hit that, preferred return, may or may not every year. But there's a big pop when you sell the property, so you don't necessarily want to put yourself in a situation where that preferred return accrues year over year over year, and you're kind of stuck behind the 8 ball, right? So that's those are two structures that you can do. So another structure here is something that we started to see like a couple of years ago when things started getting a little bit more competitive, right? The straight 80-20 split wasn't working. Straight preferred return wasn't really working, and you had to offer your investors something a little bit flashy, so to speak, right, to get them to see if they'd be interested in jumping in the deal with you, right? Because the reality is some investors have different investment profiles as well, right? Some might have a preference to just be more cash flow focused. Some might have a growth preference, right? That is okay with getting a lower return for the first couple of years, but then when you sell the property, you get that big pop to add to the IRR or the total return. So in this example here on the retail side, here's like a 3-tiered structure. It could also be a 2-tiered structure as well, where you have a tier 1, a tier 2, and tier 3. Tier 1, you have a situation where it's maybe a minimum $30,000 investment. These folks get the cash flow priority, so they get the first 10% of all cash flow distributions. However, because of the higher preferred return and the priority, they do not get the profit split on the end, right? So they're probably just cash flow focused. They say, hey, I want to get into real estate for the tax benefits. I'm okay with beating the stock market's percentage of 8%. I'm okay with getting the 10% return, right? And it shows some example metrics below there. The second tier could be same $30,000 investment, a 7% pref with a 70-30 split on top of that, right? So the first tier gets the cash flow priority. Second tier gets the 7% pref, and they also get the profits on the end, right? The 70-30 split, 70% going to the limited partners, 30% going to the GP. And then the third tier, this pretty much has a larger investment, right? So it's a $500,000 investment to get an 8 pref on an 80-20 split. And if you look down, you can see the limited partner tranches. So for tier 1, it's like $1 million. Tier 2, maybe 6 million, and then tier 3 is that 2.5 million. The reason too that you want to make sure that whatever that first tier is if you can get it to a low amount possible, the lowest amount possible that you have on an equity perspective relative to the preferred return, is because you want to make sure that you're not shooting yourself too much in the foot when it comes to having to pay your investors on a priority perspective, right? Because if that pot was 6 million, that's much more challenging potentially on the deal, depending on how the deal goes, to pay 10% on 6 million as opposed to the 10% on 1 million, right? It's probably easier on the deal to do a 10% pref for the 1 million tranche for the investors who want to invest in this bucket, as opposed to obviously the 6 million at 7% and the 2.5 at 80%, right? And relative to, again, the risk and the returns that your investors might be getting and the profit shares as well, the ones who are in tier 2 and tier 3 get preferential treatment on the exit amounts just because of the lower, the where they are in the capital stack, essentially, right? So here's a return structure that that's becoming more and more prevalent in this space, specifically for retail capital, just to provide different options for people to diversify their risk on deals, right? So that's retail capital. So now we're going to take a look at institutional capital and
so Yannick,
how
was
that
this
is significantly different.
Ranik, I have a question. Should I ask you at the end or should I ask you now?
Yeah, if it's a quick question, sure.
Yeah, I think it's a quick question. So if it takes time, you can answer me later on. But the question is, was this a $9.5 million deal? Is that how the tranches are divided?
Well, the tranches are divided. I could pull it up again. The tranches are divided depending on where you think you can cover your investors' preferred return and also their splits as well. So it's not a situation where it's like you have like, well, I'll do 10% for this equity, if it's a $10 million deal, plus or minus, I'll do 10% that goes to this tier, 50% that goes or 60% that goes to this other tier, and the remaining 30% I'll go to another tier.
Okay.
You can go in with that idea, but I think it all depends on a deal by deal basis on like how you're actually going to structure the deal in the most profitable way for your investors and also for you as well, relative to the risk that you're taking or the business plan. So it's
Right.
hard to come up with like a set percentage amount of like, you should allocate X amount to X, tier. The biggest one I would say is to definitely focus on your whatever tier that's in the first priority of cash flow, right? Because those are the folks who are going to be paid first. And if you feel like the deal isn't going to cover, based off of the amount of equity that you have to pay that pref on, then you're kind of putting yourself in a position where you're not going to be delivering to your investors the returns that you expected that you were going to. Did that answer your question?
Yes. Thank you. Thank you.
Sounds good. All right. So let me just go ahead and pull up this one here. Should just share the screen. Let's see here. All right. So looks as the screen is loading. So on the institutional side of things, it's completely different. And the reason is because, institutional capital is quote unquote a little bit different than retail capital, right? And the institutional space is much more different than the retail space. So just trying to check to see if do you guys see my screen here right now?
Yes.
Okay, you guys see the Excel spreadsheet?
Yes.
Okay. All right, sounds good. All right, so this here, this is a 166 unit deal that we are working through right now. And, this is kind of like an institutional based structure, right? The biggest thing on the institutional side of things is that a lot of times when you're on the institutional side, obviously there's an abundance of capital at that level, right? So the splits might go between 80-20 to even a 95-5, depending on the strength of the sponsor, right? And your LP capital base. So the biggest thing on the institutional side is just understanding the level at which whose capital is either at pro rata or something called pari passu. And that's kind of institutional jargon for, you guys already know what pro rata is, but pari passu is just pretty much at the same line, right? Or at the same priority, right? So a typical structure on the institutional side, let's say, for example, this is a 90-10 split here, right? And a lot of times in the institutional space, if the preferred return, let's say, is a 6% preferred return, right? That preferred return would get paid out in the sense that if the preferred return isn't met, then it accrues and compounds. So in this particular example, this $8.6 million capital injection from your limited partner, this deal here is a 90-10 to a 6 IRR pro rata, right? So what this means is that the distributions are going to be distributed on a pro rata basis. However, on the institutional side of things, if the institutional capital doesn't cover the 6% pref, it accrues and compounds, right? So in this example here, we have an $8.6 million investment. The 6% on that is around 500,000. The 90% distribution, because it's a 90-10 split, doesn't cover the 6%. So what happens is that delta gets added on to the next year. And now your LP is at a different position, not a different position, but the amount within their capital account balance has now increased and now accrues and compounds at a different rate. Sorry, the same rate, but at a different amount, right? So we started off at 8.6. The required amount to hit the hurdle was around 500,000. The 6% amount for that is 500,000, we were only able to distribute 289 based off of the 90% pro rata. So that difference gets added to the next year, and now that gets a new 6% hurdle. And so essentially what happens is that you're in a situation where if you're not able to hit that, it accrues and compounds each single year until some sort of capital event, right? Where you might be in a situation where your investor gets a return of capital and the preferred return, and then the hurdles kick in for the sponsor, right? So in this example here, it's a 90-10 to a 6%, and then the promote changes when we cover that 6% hurdle, and then it switches to a promote structure. The GP gets promoted from a 10 to a 15%, and now it goes 85-15, and then anything after a 10 could be a 70-30 split, right? And that's essentially how a lot of times private equity guys get the kickers on the sales, because if you're able to go into a deal and you say, well, I think that this deal can easily hit a 10 IRR, going out at sale, you might structure it in a way that's, favorable to where you're hitting that 10% IRR as quickly as possible relative to the promote. And everything on top of that is a favorable split for you, right? Another situation might be, another situation might be if your institutional partner wants to have some sort of preferred return met each year, and then also get the 90-10 split on top of that. And so, what you would structure is something called a GP catch-up, whereas, your LP partner, they're going to be in a much better, higher priority on the distributions line. So they're getting the preferred return and the pro rata, share of the cash flow. But in that situation, you might structure it in a way that you're getting some sort of catch up on whatever promote is structured in the partnership. So whether it's a 10% promote, if you go down the line and your LP capital partner is getting the preferred return and the 90-10 split, well, you've got to catch up for lost capital that you didn't get throughout the whole period, right? So at sale, you might have a GP catch up, whereas maybe the first 10% after your LPs are paid off, they get their capital return balance, and they've already hit their preferred return metrics. You get a GP catch up at the end to get to that 10% return, and then the remainder is split accordingly to the 90-10 structure that you guys signed up for. So I think the biggest thing on the institutional side really is just structuring it in a way that's favorable for you as a sponsor relative to the lack of cash flows that you may or may not get during the whole period, and also for the risk that you're in, obviously the risk that you're taking on the business plan as well. But I've seen a lot of the times, talking to different sponsors, the thing is that you always want to structure it in a way that's favorable to you, definitely on the back end, especially if you feel like you're going to overperform the deal. Even if your investors on the LP side understand and feel good with the return metrics that they are comfortable with, right? Whether it's a 6% return, an 8% preferred return, just structure it in a way that's most profitable for you, right? So that's kind of like a quick snapshot of the different return structures that you can think about and set up for your investors. And happy to have a quick 5-10 minute 15-minute conversation about anything that was discussed today. If you guys have any questions.
Is it okay if I go ahead and ask a question?
Yep.
Okay, so to be honest with you, Yannick, I actually got a little confused about this structure. Can you please, and then the term promote came in and I got a bit, can you please explain to me how this particular deal that you're working on now, if you could go a little bit slowly as to, what are the, what happens until 6% and then what happens, when the preferred return hits 10% and so on. That would be most helpful. And then when the term promote is used, what exactly does that mean?
Yeah. Yep. So essentially, what this is, for example, it's a 90-10 split, right? So say the total deal size here, or the total equity check here is the math between this 8.6 million and this 960,000, right? And so essentially, the LP investors will be bringing the 90% or the 8.6, and the sponsors would be bringing the 10%. And so in this particular structure here, it's a 6% preferred return with IRR hurdles or promotes on top of that, right? So it's a 90-10 to a 6. Anything after 6, the sponsors promote or profitability increase from a 10% to a 15% until everyone gets a 10% hurdle. And then above that, the sponsors profit share goes from a 15 to a 30%. So what happens is, typically in the institutional side of things, is that you start off with a capital account balance. In this example, 8.6 million for the LP investors, 960,000 for the sponsors. And so
Okay.
what happens is that the required preferred return hurdle to hit in the first year is 6%, right? That's the baseline, LP hurdle, right?
Okay.
However, it's structured in a way that it's pro rata on the distributions. So the distributions are 90-10. So the way how this deal was computes is that 90% of the distributions do not equate to 6% of the capital account balance. And so because of that, that delta goes to the next year and compounds or earns interest at 6% based off of a new capital account. So the 8.6 million plus the difference between the 500,000, roughly, minus the only paid out 289,000. That goes to the next year and earns a 6% interest on top of that. And essentially it continues to go down the line until the property achieves some sort of capital event, whether some refinance or sale. In this case, a sale. And so the LP investors would typically catch up on the preferred return and their return of capital. And in that situation, because we have hurdles, the sales proceeds on top of that, on top of the sponsor also achieving their capital back in the deal, right? The 6% goes to a 10%. And so if there's any excess capital over the 6% IRR at that level, at the first hurdle level, it switches from a 10% to a 15%. And then anything above that 10% hurdle, it switches to a 30%. So that's essentially how, on the institutional side, you get into deals where there's a lot of profitability, because if you can structure it in a way that you can hit your hurdles, right? You can make a lot of money on these deals because it's performance based.
So
did I explain that correctly? Did I explain that
I think,
in a better way?
yes, I think I understand, but I have still a couple of things I need to, get clarified. So if you go up there again with the deal, so here there is actually a 6% up till until the IRR for the returns hits 6%, the split between the GP and LP will be 10 and 90, right? If
Yes.
the IRR is between 6 and 10, then it will be 15 and 85 between the GP and LP respectively. And if the IRR is about 10%, then it's 30 and 70, right? Is that
Correct.
how to
Yes.
interpret this? So there is no preferred return over here. It's just a hurdle. There's no preferred, like, the first 8% should go to the LP. That is not there in this case.
Well, yeah, the preferred return is the IRR. The preferred return is the IRR. So if you remember in the example, so remember that the IRR is based off of time value of money.
Right. I agree.
So
yes.
If it's as the further time goes in the future versus how far the money goes as well,
Right.
impacts the way the IRR changes. So if it's a situation in the example that I showed, if you recall on the retail side of things, where the investor invested what's it called, 30% investment at let's say for example 100% investment, $100,000 investment at a 10% return per year over 5 years. That's a 1.5x multiple, assuming that they get their capital back. And that's also a 10% IRR, because the IRR represents the calculation of time value of money with respect to the cash flows distributed.
Yes.
So because it's the same amount of cash flows being distributed every year, it's the IRR equals the preferred return in that sense.
So what is the meaning of preferred return? I thought that the preferred return is that until the return is 6%, all the returns, until so when when you explain the preferred return of 8%, I may have misunderstood to mean that until 8% returns, all the returns go only to the LP, and then after the 8%, beyond the 8% returns, then they start splitting the distribution. But the first 8% all go to the LP. Is that incorrect?
It's not incorrect. It's just a different structure. It's just a different structure. That structure, if I can, let me try to pull it up really quick. That structure that I mentioned was more
for the retail investors, right? Yeah.
It was more on the institutional side of things. Oh, sorry, the retail side of things.
Retail side of things, yes.
So in this particular structure, typically, in a retail type syndication, yes, the investor would get the first X amount of return on the preferred return. The LPs would get, maybe a 7%, 8% return, and then everything above that would be whatever split that was set out when you guys started the deal, right?
Okay. So in this case, like say for example, right.
Say that again.
In this case, like if I am a tier 2 LP and I put in $30,000, the first 7%, okay, so 7% of $30,000 is $2,100. So $2,100 will be given to me first, and then there'll be a 70-30 split after that, right?
Correct. Yes.
Okay.
Yeah. And it's not to say that, on the institutional side, you may not see, a structure like, where the LP is still getting that preferred return, and, there's a 70-30 split after that. However, it is more common that in the institutional space, the preferred return is a situation where it accrues and compounds. So as I mentioned, in this particular example, the preferred return is the IRR. However, the the way that the cash flows are distributed is on a pro rata basis. And you can also be in a situation where the LP gets all of the cash flows and the GP sees no cash flows and maybe just eats on asset management fees or whatever, property management fees. But however, on the back end, when you sell the project, obviously the IRR has to be very favorable to the sponsor because they did all that work for 3 to 5 years and didn't get paid. So it depends on how you're in the institutional space. It gets a little bit more complicated on how the capital is treated at what phase of the project, and at what level, right? In this particular situation or this particular example, as I mentioned, the IRR is the preferred return technically. However, changes in the amounts being distributed factors into the total IRR as well, because the cash flows are different, right?
Got it.
Part of that is because the distributions are also 90-10 as well. It's the distributions are pro rata. The project's inability to cover the 6% just gets accrued year after year. And then once the project achieves some sort of termination, that deficiency in pref gets paid to the LP investors in addition to their return of capital as well.
Okay.
But good question. I hope I
Thank
explained
you.
that.
Yes. I think I understand this. Yes, I think I understand this. So until you hit a IRR of 6, the GPLP will split 10/90 at 15 from 6 to 10 it will be 15/85, and then about 10 it will be 30/70.
Right. Correct.
Right. Okay.
Yeah.
And then what is this 6% in the middle of this hurdle 1 thing, in the E column? What is that 6% depicting? Oh, that's the 6%, whether the 6% hurdle has been crossed or not. Is that what you're
So
saying?
this is just the 6%. This is just the 6% hurdle that is required to be
90-10.
hit.
Right.
Or else
90-10 split.
Yeah, or else that delta gets accrued into the next year and is now compounding at the same 6%. However, the capital account balance is different.
Right. Now it's increased because there's that accrued interest that's been added to it, right?
Correct. Yeah.
Yeah.
Because in year 1, we weren't able to get the 6%. So now it accrues to the next year and compounds at the same 6% preferred return.
Right. Are these numbers critical for you, in the sense that I wanted to check, and I can completely understand if these are, if you cannot share this, but if you are in a position to share this PowerPoint, and not the PowerPoint, this Excel, that will be most helpful. But I can understand if you cannot, because these may be numbers that are relevant to you and your firm, in which case, if you can't share it, that's okay too. I can completely understand that.
Yeah. I'll I can share something with you. With you. A model that would outline this particular format. Yeah, no problem. I can share this with you.
Okay, great.
I'll share with you.
Ian.
Share something different, not this exact one. That would still serve the purpose as well.
Great. Thank you. Thank you, Yannick. Truly appreciate your help. Okay.
Absolutely. Any other questions before we sign off for today's webinar? Again, I appreciate everyone taking the time to stop by, and I know there's someone else with their hand up.
Hey, thank you. So
marketed according to the measure that
can you hear me?
Yep, I can hear you.
All right. So regarding IRR, right? Some people say or object to IRR, calling it like a flawed way to calculate performance, right? And some people are dismissive of it. I just want to hear what do you say to that, right? Is if the investors are not honoring IRR as a way to measure the performance for the narrative or whatever. I
Yeah.
don't know if I face that sort of an objection.
I think the IRR is a great metric to look at because it takes into account the entire investment cash flows, and also kind of like the speed of cash flows as well. Because if you take a look at comparing this investment to another investment with the same hold period, and one investment has a higher IRR, then that might be a little bit more attractive than the other one, right? But then you also have to take a look at maybe the one with a higher IRR and do something what I call a bifurcation on the IRR, and that's basically just kind of splitting up the cash flows between what is contributing to the IRR more. Is it the cash flows during the whole period, or is it the sale proceeds? And the reason that I like to do that is because now I'm able to see how speculative the sponsor might be, right? If the if the cash flows are, maybe 3, 4, 5, 6, 7%, in the first, 5 years, and then you have this big pop, to get to some sort of 15 plus IRR, then I'm probably going to look at that reversion, cap rate, or that exit cap rate to really figure out, is this cap rate like attainable? Because a lot of times you might get into a deal and you might think that you're going to have a compressed cap rate, but you might fall into a situation where the Fed start raising rates, right? And now you thought that your cap rate was going to be 6, but now it's trading at 7 because of the velocity. So I think the IRR is really a good metric. I look at it because I'm big on time value of money relative to the risk on the project as well. And the simple thing is to just compare investments and figure out, kind of peel back the curtain on the IRR and figure out like where are those cash flows actually coming from? Is it kind of swayed maybe 55% on the cash flows and 45% on the sale proceeds? Is it 60-40 on the sale proceeds and 40% on the cash flows? Like, why is that? Is this attainable? Is it because we did a heavy value add? Is it because the market is compressing? All of the things that you could kind of take a look at as well within the IRR. So I'm big on looking at that metric.
Okay. And when we calculate IRR, we take a previous year, right? So your previous year, let's say maybe super non-performant, and suddenly now you have, because you did some evictions, got the new tenants in, suddenly the IRR will start to improve the next year, right? And so I may be wrong here, but if I see from like 5-year perspective, I feel like, okay, every year I was losing money, but suddenly because you did some turnarounds on year 5th, and now we are seeing a better IRR, and you jump right into the higher bracket of preferred return, right? That doesn't sound, fair. So that would be another way to look at it, right? I mean, wouldn't people say or object about having a consistent IRR for a certain years before a preferred return could be increased versus every year?
So I'm trying to catch the tail end of your question. So forgive me for not understanding. So can you repeat that last part again? Because I think you were getting to it. I just probably just missed.
Yeah. No. I it may be a difficult question anyway. So all I'm trying to say is your IRR can fluctuate, right? Last year might be bad, a year before might be bad, This year you did some evictions and stuff, or recovery, and now suddenly your IR improved this year. Next year it may be again bad. So your preferred return will then continue to spike along the way because of the IRR every year, versus looking at it more in a cumulative fashion for a certain number of years.
Yeah, I think I get what you're saying. So the IRR is calculated based off of some terminal value, right, or some terminal point within the cash flows. So yeah, technically, if you're looking at it from a terminal perspective, yes, it can fluctuate on a year-to-year basis, obviously depending on the cash flows being distributed and the sales proceeds as well. I think the biggest thing is just understanding or getting into deals where you understand the risk versus where that IRR return is going to be. So if I'm getting into a heavy value add development deal, I want to see upwards of 17 to 20%, and something that's core, more stabilized, probably going to see in this market maybe a 10 to 12%, and then a value add play somewhere in the middle. So it's just about understanding where those risks are within your whole period, and just making sure that it matches up with your investment profile and your risk as well.
Yeah, I see. Okay.
All righty. All right, guys. Well, I appreciate you guys' time. This was a good webinar. Again, we do this on Thursdays to talk about different topics. Happy to chat offline about anything that we talked about. And thanks again for you guys for tuning in, and we'll see you guys next time next week.